Hi traders, Chris Weston here from the research team at Pepperstone. It's been an absolutely breathtaking few days coming through in financial markets. A couple of days ago, we were talking to clients about this idea of higher for longer in terms of this rate regime. We were looking forward to the US CPI number and thinking to ourselves, could this really solidify the idea between 25 and 50 basis points at next week's FOMC meeting. Now there's even brokers out like Nomura who are calling for rate cuts and a pause in quantitative tightening. The tides in the interest rate markets have shifted radically coming through. And I think if you go to the banking sector, obviously everyone's focused not just on the US banking sector and the regional banks, but also European banks like Credit Suisse and Unicreditor and those kind of names as well. And that's spilling over into weaker bank tapes playing through in the topics and in Australia as well. I think part of this, if we look at the KRE, which is the regional bank index there, we can see that's dropped about 32% there. Bit of indecision there. We can see that big doji playing through and be interesting to see how that plays through. We want to see a bit of volume coming back in on the buying, and that could give us a bit of life back into the broader market. Yeah, I think there's people suggesting that some of the bigger banks who potentially benefit from what we've been seeing. There's certainly a migration, I think, taking place amongst investors and certainly depositors in the US at the moment back into the stronger banks. Strong is good. Anyone who has a sort of a contained asset base effectively is going to be less susceptible to runs. I think, even though we've seen the FDIC, the US Treasury, and the Fed moving to shore up the deposit confidence effectively by insuring anyone over 250,000 and showing everyone a roadmap of what failing banks look like. There's still going to be a run, I think, towards more and a migration and divestment towards more stronger banks coming forward. So I think that's definitely an interesting trade. So we're just watching the tape of the banks. JP Morgan, Bank of America, Wells Fargo, those kind of names. I think certainly JP Morgan, I think, is an interesting one. If we see some buying coming back in on good volume, that could send ramifications through there. So we are watching that KRE, also watching the HYG as well. I think this is a really interesting one because if we are going to see potential slowdown playing through, I think high grade credit, which is a really interesting one here. If price moves up, effectively what it's telling you is that high yield credit spreads are coming in, and if price goes down on this one, what it's telling you is that high grade credit spreads are widening and widening fast. So that's something that we want to watch there because we have seen high yield credit spreads coming under a bit of pressure, and you've seen spreads widening effectively, the HYG, which is a really good barometer of risk in this market in terms of credit risk coming forward. I think is something that everyone needs to have on their radar. Now, in terms of the rates repricing, I think what's interesting is we've got this new facility called the BTFP, which is effectively the bank term funding program, where banks can go and address the funding of their assets on their balance sheet by going to the bank and using all these government debt and government securities, effectively mortgage-backed securities, government agency debt. And even if it's trading a discount to par, they can actually go out and get collateral for 1 year at a reasonable expense, but effectively they can take that and get collateral from the Federal Reserve for 1 year and address the funding needs, and that bond will be treated at par effectively, rather than the actual discount that it's trading at in the market because of what's been happening in higher rates. So that's a really big deal for markets, but certainly we're going to see the Fed's balance sheet increasing as a result. Now, what does this mean? It means that we're going to see much more conservative lending. In my opinion, we're going to see higher regulation playing through the banking space. And that's going to have severe implications for the supply of credit, the sourcing of credit, using the deposits on their balance sheet effectively for loans. And I think you're going to see that reverberating in headwinds for economics effectively. And I think the market's sort of taken that one and says, well, why do we need such big interest rates? I know obviously we've got concerns around solvency of other banks as well, and the impact that potentially could have with contagion. But I think we're also going to see the banks really look to have much more conservative lending. There's going to have to be much tighter regulation, and that's what we've been seeing in the financial markets now. So if we have a look at what's being priced for next week's Fed meeting, you can see 19 basis points being priced there. You can see the code that I'm running with on my trading view title there, so you can effectively use that code. And if you take that away from 100, which of course is par, we can see that for the next meeting coming up, we can see 19 basis points of tights coming through. Now that's really important. A few days ago we were sort of debating whether we were going to get a 50 basis point hike. There was like a 70% chance of that happening. Now we've got 18 basis points out of 25 being priced in. So yeah, obviously we'll see what happens with tonight's US CPI number. Yeah, if we get a number north of 0.5% month on month from core, then I think that could push back up to sort of 25 basis points. But the banks like Nomura and Goldman Sachs, Nomura obviously calling for 25 basis point cuts now, and Goldman Sachs is saying we're going to see a pause. They would probably say that because of this slowdown in the banking sector, because what we've been seeing there, that potentially we don't, that the CPI number is kind of irrelevant really, because it's so backward looking. It's about what CPI is going to look like when demand's being hit and the supply of credit is going to become somewhat more problematic going forward. So we've got about 19 basis points of hikes. Now, what's really important is if you can go to where we were the other day, go back to where we were on the 8th of March. You can have a look at the Fed funds future, and I've looked at the September contract. And the reason I've used this one is because when I was looking at my rates table the other day, when I've looked at the different Fed funds contracts, the other day we could see that the terminal rate, or the peak pricing, was set for September. So that's kind of where I've looked at that one. And what we can see now is that, this was trading at 5.68%. So the market was effectively saying that the Fed funds rate, the effective rate, could get to 5.68%. And over the last 3 trading sessions, we've seen it drop down to 395. So it's about 170 basis points, just under 7 rate hikes if you're using 25 basis point increments, being priced out the market in 3 days. That is as extreme as you're ever going to see in any kind of rates pricing playing through. We're now left with a situation where we've got 19 basis points priced for the next meeting, 9 on top of that one. So we get to about 27 basis points by the May meeting, and then it's cuts all the way down. So we've basically got the Fed cutting from around June, and we're pricing about 80 or 90 basis points for that situation. But look at this repricing we've been seeing, 170 basis points coming out of the market here, and now we're just starting to see rate hikes being priced back in to an extent on the day. It's interesting if we have a look at Aussie rates pricing, which we can't see here at the moment. The market is essentially saying that we're going to see no more rate hikes. In fact, we're going to see an element of cuts playing through at the next meeting, 2 basis points of cuts, which I think is a bit silly, to be honest. But that's where we are. We've got the ECB meeting later on this week on the 16th. The market's pricing 39 basis points of hikes there. I think that's free money, in my opinion. Well, it's not free money. Nothing's free money. But I think that's going to be a situation where the ECB will raise by 50 basis points, and there's 11 basis points picking up there for people who are looking to pay for that meeting. I think that's probably going to be one that you're looking at the euro very favourably. And in the UK now, we've got about 34 basis points of hikes being priced until we get to that point. So that's where we are. We've had this massive repricing. This higher for longer has come out of the market, and we can see that in the 2-year Treasury. So that rate repricing, we've seen 2s going from 508 down to 395. I think what we saw on this rundown here was a lot of people looking to who are short, short the front end of the curve. They've obviously come down. The leverage community, the fast money community, have been bleeding on the way down here, and you've seen a lot of automatic stop outs. You've seen margins coming through, and a lot of forced stop out from the sort of the hedge fund communities. And we've got down to this very much an overbought level coming through, and I think we're just seeing this up about 20 basis points on the day there. So that's a really interesting one. How's that feeding through into the dollar? Well, we saw the dollar coming down into this level of support, which was this prior low from December. We've seen that just pretty much hit on the dime, and we're seeing a few buyers playing through. So clearly the US dollar is moving very, very closely with what we're seeing in that 2-year Treasury and that rates repricing. We can see that also in dollar yen as well. We had this big move down from around 137.92 down into 132. So a decent clip coming through there. We're seeing good buying coming through in the JGB market. But again, we're just pushing back up a little bit on the day. We're up about 60 basis points, and we're obviously watching what happens in front-end yields. There's so much volatility playing through in the bond market. We can see that in the MOVE index, which of course takes the implied volatility over a range of different US Treasuries. And you can see the implied volatility is just absolutely gone for it coming through in the Treasury market. One of the biggest moves we've ever going to see. And again, you can see that in rates volatility as well. One thing we are looking there is what's happening in gold. As yields move lower, as real rates move lower, as the dollar moved lower on the back of what we've been seeing there, we saw gold prices trading up to 1916. We saw Bitcoin also having a really strong run, moving up into 24,568, just threatening to take out these sort of February highs playing through. But again, something we are watching very closely. There's been a very, very powerful move as those rates come out of the markets. And we can also see that playing through in the NASDAQ as well. We can see these long duration assets really benefiting from the rates repricing that we've been seeing. You've got this double bottom playing through. The market traded below those lows. We sort of held that very nicely indeed. We're just making a little bit of a higher high through that body. Can we take out this series of highs around 12,084? If we can do that, there could be a momentum long to try and take this one higher. We'll have to see what happens there as well. Obviously, US CPI numbers are very much going to be telling. The market wants to see a number below 30 basis points month on month core. And that could justify this rates pricing that we've now seen in the market. Obviously, as I say there, the problematic situation is if we get a number above 0.5% month on month on core, that could put the cat amongst the pigeons and see the dollar rally a little bit, and I think risk could come under a bit of pressure. Now that the market is kind of saying that the banking crisis could spill over into something a bit more punchy, more in the economic world, a higher CPI number could become somewhat a bit of a concern. So something we are watching in the trading session ahead. We are seeing massive volatility, but we are now also looking at a market that has repriced itself. Clearly, the 2s10s curve being at negative 110 basis points. Clearly, this higher for longer with some people pricing a 6% Fed funds is not conducive of economic activity. The market has broken, and we've seen banks starting to fail in terms of their asset quality. Obviously, the thing with the SVB bank was idiosyncratic to an extent. I think the regulators kind of failed them a little bit, but I think we are seeing that the fruits of that higher for longer mantra really resonating in the banking sector. We've got our eyes firmly on the banks as we go along into the trading session ahead. We've got our eyes on that CPI number. We've got our eyes very much on that US Treasury market. But the interesting conundrum that we are seeing now is that we are looking at rates curves which are no longer pricing in rate hikes and we're starting to price in rate cuts. What does the investment community look for that situation going forward? That's for us to trade. Trade with the respect of the volatility playing through in the markets. Good luck.